Hello, and welcome to day 4 on at the end of week 1 of UK market missions. It's been a great week, and I've got to say it's been a tiring week as well, but the team's been working very hard to get this across to you, and hopefully it's landing very well for you. So yesterday was a great day in terms of regulation and Brexit. I certainly got some new insights around the thinking on the potential of a no deal situation, but ultimately what came across me yesterday was that 2021 should be a really interesting year, and hopefully a very good year to be a fintech coming into the UK marketplace. And on the regulatory side, obviously, make sure that you've got the right plans in place, the right type of application, and obviously whether you need an application, because that's obviously a key thing for some companies. You're on the cusp of having to decide that. So today is really all about sort of putting boots on the ground and setting up in the UK. Many companies don't necessarily spend enough time thinking about this, whether it's the mechanics, so accountancy, tax, legal aspects. So we've got 2 of the best people in the game from Uri Clark, Ross and Ian. And Uri Clark is a fabulous business that is unusual in the UK. It does both law and accountancy. And they've got huge amounts of experience bringing in many dozens or perhaps even hundreds, I would say hundreds of companies from overseas markets into the UK, and many of them technology ones as well. I know they're very strong supporting Kiwi and Aussie companies coming across here and across the world. And so it'll be fascinating to hear what their thoughts are. And of course, this session is a masterclass, so there's no need to speakers afterwards. So please ask away during the session, and we'll have obviously a Q&A at the end as well. So we're sort of due to wrap up session 1 around about sort of 9:15. There's a bit of flex there. And then in session 2, I'll be supporting Zoe Spicer. Zoe is, in my mind, one of the sort of leading HR and talent experts, not just in the UK, but globally. For the last 5 years, she's been working with a number of very successful B2B software companies, many of them fintechs, and helping them sort out the talent strategy and making sure that talent is front and center of many of these companies' plans and execution. Because without the talent, without the right culture, business gets a little harder. In fact, a lot harder. So Zoe's got some amazing experiences, and I'll obviously join her in talking about how to sort of locate the right people as well. So I think we should kick off the first session. I'll hang here in the background. Ross and Ian are looking resplendent, and the Uri Clark officers, I've got to say, are looking quite interesting today. But I'll hand over to yourselves to sort of kick things off. Over to you, Ross.
Thanks a lot, Pete, and welcome everyone to this session on some top tips on setting up a UK presence in the UK. I've got a PowerPoint presentation, so just to help us and guide us through. But obviously, please feel free to ask questions during the session as well. What we'll do today, we'll talk about some top tips on setting up in the UK and run through some focus areas. I think for many of you who don't know new founder Uri Clark, I thought it'd be useful just to give you a bit of background. Newfound, we've been working with Newfound for quite a few years now, and like the name, a complete breath of fresh air for someone like me who's been helping international businesses set up in the UK over the last 10 years, and and for Ian as well, who's been doing it since the beginning of time.
Yeah, I'm the old git.
And what Newfound can do is provide that market validation, provide that market entry, and they're also hiring specialists so that you can get the right individuals that know the local market. As Pete mentioned, for our sins, we're lawyers and accountants, but we think we offer a lot more than that. We offer a full range of professional services, including payroll and employee benefits, to name a few. And why do we work so well together, Newfound and Uri Clark? We do have the same goal for you guys. We try and cut the red tape. We try and offer that simplified, straightforward approach in advice and support. And we've got many success stories. What we'll do today is run through, like I say, the top tips, and we'll give you a few not so good stories as well where it went a bit wrong, and so that you're aware of what you need to do and make sure you get it right first time. But what we'll start off with is, well, why should you expand into the UK? And Ian will talk you through that.
I mean, just a quick overview here, because I think you've already had a lot of sessions on this. So it's really just from our perspective. The UK still is a massive attraction for inward investment. It's a huge marketplace. People are willing to do business, and particularly fintech. Obviously, we're a massive financial centre, one of the world's largest financial centres, have been for hundreds of years, and I think that will continue, Brexit or no Brexit deal, whatever happens. So it's a great place, and the reality is the tech sector is thriving here. We've got, I think it was 10.1 billion of investment, venture capital investment in 2019 into the sector, and people want to adopt new technologies. I mean, one of the things we know we've got to do as a nation is, be cutting edge. We want to attract business, attract talent, attract that technological development to survive in the future. I think that's true of any country, but fintech adoption rate has been 71% over here. So any sort of very much, a high adoption rate, we believe. I mean, obviously bear in mind we were on quill pens and checkbooks until 20 years ago. And another thing is that there are, I don't want to sort of preclude what Zoe is going to say, but obviously massive amounts of people, talent here. People love coming here. It's a great place to work. I know there are obviously a lot of other places other than London, but London is a particularly good hub for fintech, and people want to work in London, and why wouldn't you? So one of the partners I know that we're both Newfound and I are with our London partners. If you are interested in London at all, they will offer you a massive amount of help and advice. So I'm sure you've already been told that, but do look them up. And just another thing, I think just culturally, the UK is sort of obviously a mature market, has a very robust legal system, intellectual property protection, and so it's a market that you can trust. Typically, so it's a good place to be. Big market, big opportunities. Back to you, Ross.
So now we'll run through some of our top 5 tips, and we'll tell you a few stories along the way. The first tip is in relation to visas. You might be surprised that you might focus on the company setup and structure, but sometimes the first question is, what visas do we need for staff that you want to transfer to the UK, and maybe also for yourself as a founder, or for your key person to set up the UK. It's all about the timing here. Timing is key. Getting this right. Don't make the mistakes that I've seen happen in the past, where people rely on visas that don't fit the needs, that are not work visas. The main one is the business visitor visa. I've seen that mistake many a time, and I'll tell you a story at the end of this tip. So focus on what visas. It's key to your initial setup. The first one I want to discuss is what is known as the sole rep visa. That's the representative of an overseas business visa. What I describe this as a once in a lifetime visa, because it allows you to send a senior member of your staff to the UK to help with the setup and the expansion. You've got to do this before you've started trading or recruited any local staff. The basis for this is that you will have to register a branch in the UK, which means you register the overseas business in the UK, or you set up a 100% wholly owned UK sub of the parent company. So that's the requisite. It's also an option for any owners of the business, provided you don't own a majority stake in the parent company, the overseas business. So as long as you don't own more than 50%, you can explore this visa option. The visa is granted initially for 3 years. It's extendable by 2, and after 5 years, it can lead to settlement. Failing that, yeah,
Is
sorry,
this,
Pete.
sorry, no, I was just going to say, is this visa typically always accepted or offered?
Provided you meet all the requirements of it, yes. You know, we find that where there's a typical setup, which is normally a UK limited company, the UK sub, it's the best option for your staff. I normally find that a lot of businesses might be sending 3 or 4 people over, and what we would do is look at the personal circumstances of the 4, and sometimes they might be at the same level, all senior people, and it's working out the timing, and actually one person might not have any options at all, and this is where the sole rep works for them compared to others who might have other options, and that's the key. It's getting the timing right. Who do you need over first, followed by the rest if you're looking for a number of people. Failing the sole rep visa, you then have to look at maybe personal work visa circumstances. It will very much depend on the nationality of the individual. It may also depend on the country where they're based at the time. Some prime examples are if the individual's parents are British, it's quite straightforward. British passport, there you go. For particular nationalities, grandparents who were born in the UK were British. So your Australians, Canadians, New Zealanders, they can get an ancestry visa, which grants you a visa for 5 years and leads to settlement. There's then maybe more for more junior staff. So you're in the 18 to 30 bracket, maybe your developers in your home country that you normally find are quite transient, going from place to place, that you want to keep engaged in the business. There is an option for particular nationalities for a youth mobility visa, which offers up to 2 years. Also have a look who they may be in a relationship with or married to. If the spouse is British, or they're in a relationship with someone who's British and they've lived together for more than 2 years, there's an opportunity of a spousal visa there. Other than that, for staff, we would normally consider tier 2 sponsorship. That's where your UK business needs to get a tier 2 license. I won't go into detail in this session on the tier 2 sponsorship because the UK visas and immigration are changing the rules come next year, partly due to Brexit, but they're also trying to make it more flexible so that global talent can enter the UK. So watch this space on that. Otherwise, if you're the owner of the business and you don't meet the sole rep option because you own all the shares in the parent company, or the structure doesn't suit, there are some options, but the main one I find is, which is the most acceptable and straightforward option, if you can call it straightforward, is the global talent visa. And that allows someone who is talented and promising to in the field of digital technology to come to the UK. You're going to have a big impact on the UK. It's a 2-stage process. The first stage is an endorsement, and the endorsing body is Tech Nation. So what I would always advise is get in touch, start a relationship with the Tech Nation people just to see what their thoughts are. It's very document heavy. It's about you basically selling yourself of why you would make such a great impact, what your history is in success in business, and it's also who you know. You need 3 referees, and if they're well-known individuals in tech, or they're from tech businesses that are well known, you can't go too far wrong with that. The last point is about the business visitor visa. The business visitor visa allows you to carry out certain permitted activities, and they're normally pre-entry into the UK market, explore the UK market, come over and meet potential people that you can collaborate with, find out about the best way to set up your business. You know, you can do it you can use the visa for that. And normally if you're a say director of a business or you manage staff in the UK, it allows you to come over and attend meetings with the staff. It's quite useful in that you can spend up to 6 months in the UK, but don't make the mistake of thinking it just allows you a free for all to work, as a few clients have thought so in the past. I think my worst story I could tell you about is we started working with a client a few years ago who'd already set up, they've already dipped the toe in the pond over here, and they were just trying to make sure they've got everything in place, and we were having to go through the process from both accounting and legal perspective. What came out of that, even though that wasn't the focus of the discussion, that they had an individual over here working on a business visitor visa. We obviously advised them to remove him from the UK immediately and look at other options. And at the time, they hadn't started their active trade as such, so the sole rep would work. What they didn't tell us is that when they sent the individual back, they then sent someone to replace them, just to cover off what he was doing, whilst they got the visa. And unfortunately, he got to border and was questioned. And when they looked through his baggage, there was an unfortunate email that said, whatever you do, don't tell them that you're working, otherwise they won't let you in. And sure enough, they didn't let him in. And the time it took us to resolve that issue with UK border, it took a long time and scuppered a lot of their plans. So this is the key takeaway here. Make sure the plan, you plan ahead and make sure that you're ticking the boxes, because the last thing you want is the UK border force all over your business. Another takeaway here is that if you are entering on a business visitor visa, you've got to be aware of tax residency issues, that whilst you're not here to work or you're not here to reside or on a payroll, if you do, and the rule of thumb here is you can't spend more than 183 days in any 12-month period, you could be triggering tax residency if you go beyond that. And also, if you do have a UK company with a payroll and you come into the UK on business visits, there will be reporting requirements to our tax office, HMRC, for where you spend more than 59 days in a tax year. So you must keep records of the days and activities you're carrying out for the UK businesses reporting obligations. So takeaway here, timing is the key. Make sure you explore the options carefully and plan ahead.
It's a great point. I mean, there's a company I know very, very well who messed this up at the beginning, messed up really quite badly because they hadn't really got good advice. And what happened, they had to spend about 1.5 years going through different hoops and processes and legal expense and flying in and out to try and sort of please UK borders. And they reckon it costs about 100 grand to fix. So it can be done easily, or it can be very expensive and painful.
Quite right.
Yeah. Thanks, Ross. I think just there's this is a nice little slide here, 3 bullet points. We've kept the slides brief with a wealth of information and stuff behind it. But just to take a step back from even the slide at the moment, I think there's sort of 3 key things we come across all the time. And we would normally say form a UK company is the easiest way to set up. And it's basically, and I'll come on to that in a moment, but two reasons you may not want to do that. And the one is obviously the first one is quite a lot of times people just send someone over to try and see how good the market is as a salesman, try and open relationships, see how successful this business is going to be. So you can just send someone over without having any formal business structure. And obviously one of the key things I'm sure your parent company advisors will tell you is what you're trying to avoid is what's called a permanent establishment in the UK, where suddenly that business becomes tax resident because these people have been here for A, too long, or B, they're actually conducting business and closing business here. So, but there is a sort of the light touch, which is if you've got a salesman, he's out selling, and actually and all the contracts are being dealt with back at parent company HQ. So you're not closing contracts here. You're not actually conducting business here as such, you're just sort of out marketing, selling, then that sort of avoids the permanent establishment. But it's a very grey area, and the rules across the world, OECD are desperately keen to, obviously capture all taxes and make sure people aren't avoiding taxes. So there's quite a lot of scrutiny on that, but it's just, that's the sort of the first point. So yes, it's fine to send someone over, try and start selling, and you avoid that. But assuming you're sort of beyond that, the other reason you may not want to form a company is purely from investment purposes. If you're an overseas business looking for UK, maybe typically angel investors, I've got a brief slide on this later because I know you've had investment sessions, but then obviously there's this thing called the EIS scheme, and that has to be a business. You have to either invest in the parent company or it has to be in the top co. It can't be a subsidiary company. So if you want to have UK investors and who qualify under that scheme in the UK, then you need to have a branch here. If you're not forming, if they're not, just so that there is a business in the UK, so that you'd have to have a permanent establishment, which quite a few people do because the investment's attractive. But I'll cover that a bit more later. But most of the time, people are just commercial businesses, want to set up, and we would always recommend, first off, UK company. Bullet point one, ease of investment operations. We say ease of investment, people understand shares, people understand they're buying a percentage of the company. But operations is the key, because UK companies, it's just so much easier for registering for taxes, for registering payroll schemes, for dealing with commercial contracts, for dealing with, if you want equipment hire. You'll be amazed. I've got clients, even UK-based clients, and they're partnerships, general partnerships, some of them big partnerships, effectively unlimited liability, and hiring companies say, oh well, we don't understand that. We want a limited company to, for your photocopier hire, or almost. It's bizarre, and quite a few landlords as well. So you find that having the limited company gives you ease of access to just general commercial arrangements. People can look you up, say, yeah, that company exists, that's great. But the other thing it's also a lot easier for, which we'll touch on a bit more on another slide later, is opening a bank account. It just means that, it's a UK company, it's a UK account. It makes it easier. I'm saying easy, much less difficult, and Peter and I we'll talk a bit more on this later, because it is the biggest pain. It's very easy to open a company here. There's the minimum share capital. You can open it for £1, less than £1 even of committed capital. It's usually formed within 24 hours. We have known it to be done within 58 minutes. But I think, after COVID, Companies House are slightly, should we say, slower than they were. But certainly I've formed 2 companies within the last 24 hours. Both have been in within that 24-hour timescale. So very easy to set up. Equally, if you're finding it's not working out, it's relatively easy to close as well. People do tend to sometimes just close them without thinking. There's a few consequences, but basically very easy to start, very easy to finish. You don't need a UK director. They don't need to be a resident director, which is another thing that surprises quite a few overseas businesses. So you can just form them with directors from HQ, wherever. The only sort of caveats I would put on that are FCA regulation. I know, obviously in fintech sector, a number of you will fall into this category. FCA will typically require a UK director, and also some of the banks, which again we'll come on to, sometimes require a UK director. But overall, it's a nice simple structure. There's no withholding tax on dividends paid from the UK to an overseas holding company. So that's obviously quite often attractive. Tax rate here, 19% corporation tax. So, it's a relatively low tax jurisdiction, taxed on your profits here, but then you can distribute those profits up to the parent company with no withholding tax. It's just the easiest way, tax efficient, and as the bullet point 3 says, we also have the largest tax treaty network in the world. And so there's a lot of favourable, tax treatments between different countries. Typically, most of the countries that set up here, there's very likely to be a tax treaty, which gives you, again, preferential treatments. So that, Ross, do you want to move this? I've said on Pete's mentioned that you've had a separate thing on FCA compliance, so I was just going to be really quick on this. And I'm sure this is just reinforcing what you've already been told. Get in early with the FCA and start a dialogue, very important. They like people to talk to them. They're actually very helpful in terms of having their teams there to discuss things. The three key words, as I'm sure you've again been told: ready, willing, and organised. Ready is that, and ready for them means that you've actually looked at their website, you've made contact with them, you've started talking to them, you understand the rules, and willing is that you're obviously being very open. You're willing to be honest, open with them about your business, what you're doing, what your plans are, and providing information. And organised is that you've got all the information to hand and that you've got everything ready for the application. Application fees are non-refundable, and for complex businesses they can be up to £25,000. Typically it's about 1,500 to 5,000 for an application. So, and it's a very bureaucratic process. I've said I don't know what you've been told. I mean, I think we found now, I think certainly post-COVID is allows 6 to 12 months. They say up to 6 months for a simple application and 12 months for complicated applications, or where not all documents are ready. But I think you've just got to allow it. It is a bureaucratic process. It does take time, you know, and obviously, you know, typically, you know, you might have to wait several weeks after submitting something to get responses, and there's usually a lot of backwards and forwards. But the FCA has a lot of useful online tools. Look at their website because they are very helpful. They've got all the forms there. They've got, you know, decision trees as to whether you feel you should be regulated or not. But it is a very complicated area, so it's one where you do want to take advice and get some local assistance in terms of understanding, you know, where you fit. As I think Pete alluded to, when you're on the cusp, particularly, sometimes it's obvious, sometimes it's not. But you don't want to get it wrong, because the FCA is one body you definitely don't want to fall foul of in the UK. They have some quite draconian penalties and sanctions. We're registered with them for our financial services arm, and you know, we make sure we stick to the rules, and we're very open with communication.
And then maybe your biggest challenge in the UK, surprisingly, is opening that UK bank account. I think this animation basically sums it up of what it's like to sort of cut through and get that bank account open. It's mine, Ian's, you know, Pete will tell you the same. It's our biggest headache sometimes for clients, surprisingly. You can look at the traditional banks, and there's a couple of new ones such as Metro. The thing that we found recently, because we do support our clients on this, is that many have said they're not open until the new year now, even if that, which if you're expanding to the UK, you need that UK corporate bank account. One that really seems amenable to tech companies, particularly fintech companies, is Silicon Valley Bank. It's worth starting a dialogue with them. We've got contacts that we would introduce you to, and they seem very keen to see if they can work with you as a customer. It will take time though. Other than that, there's the challenger banks that are really trying to break this market, the Revoluts and Tides of this world. We're finding that Cash Plus is, whilst they don't offer the full range of services of your traditional bank, we find people like Cash Plus are a great go-to. The only downside for Cash Plus is that there is a cost for the due diligence, because this is all about the AML, the KYC, you know, making sure they don't breach anti-money laundering rules. It's £1,000 to get the DD done by Cash Plus. If they don't accept you, you lose the £1,000. You don't get it back. But I do find with tech companies, they seem very keen to work with the tech companies, and I've not had any issues there. It is what it is, unfortunately, guys. You know, follow their instructions. You're going to have to be patient, and it will be your greatest challenge. As I say, we can work with you to try and support you through this process. There are the partners that we work with, you know, Newfound will obviously support you. There's London and Partners. If you're looking to set up in London, you know, be ready for this. This you'll probably find is your greatest challenge.
Yeah. I mean, I would just say, I mean, I'll just add to that. I mean, just as a horror story, a Nasdaq listed US business who you might think would be, relatively easy to get a bank account open. They insisted on going to Barclays Bank because that was, they knew them and they had a relationship, and Barclays at the time were, the worst actually bank for trying to get anything done, even if it was, the simplest of things. And we warned them against it. And after 8 months of trying to get an account opened with Barclays Bank, they finally gave up and went elsewhere. But that just gives you an indication of how painful it can be. So you got a Nasdaq listed US business, and a Barclays couldn't open an account in 8 months.
Yeah, and likewise, we had a Finnish fintech that couldn't get a bank account open. It was taking them over 12 months. They went to Silicon Valley Bank, and they opened it fairly quickly after that. I mean, fairly quickly still takes a few months, but it was a big turnaround. So it's what I would say is, at the moment, unfortunately, NatWest, Santander, HSBC, Metro, I'd probably ignore those for the time being. Focus on Silicon Valley Bank and look at the challenges and talk to them.
I mean, there's so go on, Pete.
I was going to say Silicon Valley Bank, a great team down there, and I've sort of got to know them quite well over the years. But they all really only consider you as a customer if you have US ambitions as well, because they obviously want to help you grow into the US. So that's the only sort of caveat I think about Silicon Valley Bank, the US angle.
And then the next tip is to dealing with your talent. The biggest mistake I see happening is, there's a number of things. There's businesses that send the staff over thinking that they can just look at the market like that. You need the local talent. You need to embed people. You need a good mix. So you need the values of the company, the employer brand, as well as the people with their ear to the ground. The other one is is actually people saying, well, we just want to see how it goes. We're just going to dip our toe in the pond, and we're going to engage them as a contractor on a self-employed basis, so we don't have to deal with payroll, taxes, and employment law rules. We'll be okay. It'll be all fine. It won't be okay. If they really are, in all intents and purposes, an employee, they're working solely for you. They're having to work day by day for you. They're an employee. Treat them as an employee. Don't be afraid of that. The risk that you leave yourselves open to is an HMRC investigation, and you have to pay penalties and payroll taxes because you haven't correctly paid them subject to our tax system. And also, I normally find if it hasn't worked out with that contractor, even after 6 months, 9 months, they will try and claim some employment rights against you and say, well, I was an employee all along, even though you may have agreed that with them and shook hands. They can turn around and say, well, I think I was an employee, so I deserve some rights here. So if they're an employee, employ them. Don't be afraid of UK employment law. I find it quite well balanced. The main claim that you see in the UK is unfair dismissal, but you need 2 years continuous service to be able to bring an unfair dismissal claim. So in the first 2 years, there's a lot more flexibility if it doesn't work out. If the person isn't the right fit for your organisation, if performance isn't what it should be. After 2 years, it gets more complicated. That's I'll tell you that straight away, but there is a flexibility with that. Hopefully you'll get the right talent. Also, if you're sending people on the visas from HQ, there's tax efficient ways of doing that. Put them on a secondment, and if you're looking to explore the market with them in the UK for up to 2 years, there's some great tax savings. Depending on which country you're from, there's in terms of payroll taxes, there's national insurance that you have to pay on top of salary as an employer. You get a national insurance holiday for certain periods, depending on where you are in the world. So if you're coming from New Zealand or Australia, it's 12 months. The same for India. For places like the US, you might be able to get that coverage for up to 5 years. And in terms of if the initial intention is 2 years, you can be quite clever with the salary. Rather than just pay a base salary, part of that salary can be sliced off towards rental, utilities, travel expenses. There's no fringe benefit taxes that are attracted to that, so it's tax free. It's a win-win for the secondee and for the company. The company saves money, and the employee gets more money in the back pocket. So it's worth looking at that and exploring that in the right way. If you're hiring local, get the talent right. What they're required to be given by law is a written statement of particulars. It sets out the basic terms. What we would advise is get a fully detailed employment contract. You want the protection on confidentiality. You want to be protected on IP, and also the post-termination restrictions, particularly when you've got the sales staff who are meeting your customers, winning the clients. You want that protection. Then there's payroll and pensions. Payroll, we support our clients on. We can turn it around fairly quickly, normally between 1 to 4 weeks in a lot of cases. As I alluded to, there are payroll taxes, there's employers' national insurance contribution. The national insurance contribution on top of salary, it's roughly about 13.8%. So you can see the saving with the tax efficient secondments if you can slice that bit off, your costs. There's also pensions. Pensions are normally auto enrollment, 3% on top of the base salary that the employer has to contribute, albeit you can also do it on qualifying earnings, which is roughly between 6 to 40k. Based on the pension regulators' advice, if you're on secondment, there's not a requirement to auto-enroll them. And if they're only here for a short period in the UK, why would they want to sign up to a pension here anyway? That would be the question. So you can potentially not have to provide that. In terms of other benefits, there's not a legal requirement as such, but what we normally see is maybe health insurance. We have got our NHS here, that anyone who comes to the UK on a work visa gets the right to access our National Health Service, but the health insurance will get them at the front of the queue. In terms of insurance and compliance, obviously you'll want to make sure that you're protected from an insurance perspective. There's one compulsory insurance, employer's liability insurance. You need that from day one for your first employee or secondee. The insurance is a minimum 5 million coverage, but it costs normally about between £300 to £400. If you don't get it in place, and I've seen it happen, and this insurance is to cover basically an injury at work, you could have a big liability there, and there's criminal charges and also a cost of £2,500 a day if you haven't put this in place. So for the sake of £400, get it set up. The main takeaway from talent is recruit wisely. Ian has a really good example of clients that have met someone at a trade show and thought, yeah, this person is great, and it didn't work out. You need to think about your onboarding processes that Zoe Spicer will cover, and Pete. You need to think about your brand, make it a great experience for these recruits. This is you, as well as them selling it to you. You're selling why it's great to work for you. You want to get that good PR in the UK that you're a company to go and work for.
Yeah, that will be covered by Zoe with a lot of good insights. But I think some interesting questions that I think need to be thought about here. Can you have operate a UK payroll without a UK bank account? If your bank account application is delayed and it's 6 months, can you still pay UK staff?
Yes, you can. That's no problem. You don't need the bank account. So we, for example, we have a client account. So all of our payroll clients, which there are I think there's now something like 470 companies that use our payroll services. We operate a client account so they can pay it through us. So we just work out the payroll and give a monthly thing and say, right here, this is how much you need to pay into the account. Then we can pay all the employees directly, pay the payroll taxes to HMRC. So you don't need a UK bank account. It's something that we can operate for you until that's in place. And even after that, some people just prefer to that's just, they make it one payment a month and don't have to worry about it.
Yeah, the main issue is it's about having a direct debit for pensions, but again, we can provide temporary measures while you're trying to get that bank account. We did that with the Finnish client. We supported them so that they could make the appropriate payments to staff. So there are ways around it as an interim measure. Okay.
Ross,
so we'll move on to some focus areas. That the main one we want to cover is some of the grants in the UK and investment, and Ian will run through this with you.
Yeah. So I think one of the sort of most generous reliefs and sort of effectively grants that are available is research and development tax credits, R&D, and the UK system is extremely generous and extremely flexible. And we've got, it's probably the biggest growth area of our business actually, is processing these claims, which we've been very successful at. And it's open to all companies, but so there is a large company scheme, but we're guessing most people on here are going to fall into the SME bracket. And for you, there's effectively, it's possible to get sort of 33% of the spend as a sort of cash back. That works in sort of the following way. There's for every £100 you spend on qualifying R&D, then there's you effectively get another 130% of sort of tax deduction on top of that. So if you spend £100, you get a £230 tax deduction, and that effectively comes off your taxable profits, and and obviously has a benefit, UK corporation tax at 19%. But if you're not making money yet, so quite a few, obviously, of the startups, the innovators are not in a sort of revenue generation mode necessarily. So if there are losses available, then you can sort of cash in 14.5% of the available tax loss as a cash back. So if you had a loss of that £230, obviously that's where the sort of 33% comes from. It's 14.5% of that value you can get as a cash back. There's no minimum spend, and in the UK there's a very sort of loose definitions of what can qualify. So there's as long as there's some innovation, it's solving a problem. There's a problem to be solved and the work's being done. So it's surprising. I've got a client who's a sort of travel company, package holiday company. They spent quite a bit of money on their website, on the booking system, and we managed to get an R&D claim for that, because it was solving a particular problem they had in terms of the volumes of people, etc. And that qualified. So it's quite generous. It doesn't have to be particularly, focused on tech, super innovation. Is it solving a problem? And also the sort of costs are quite generous. So it's obviously staff costs, direct and indirect. So if management is spending time on those projects, if there's training for those, training needed for those R&D costs, then that can all qualify. Even better, the expenditure doesn't have to be in the UK. So you can actually, as long as the R&D is being directed from the UK, that's the sort of key criteria really, is that the R&D is being directed from the UK. This is where you do need a UK company to be able to obviously claim this, because that has to be directed from the UK. And there has to be perceived to be some benefit to the UK. This technology, once it's developed, or this, this enhancement will, has got the potential to benefit other people, etc. So, but actually, so it can be very flexible. So if you've got a UK company here and and they're managing the process, then obviously that a lot of the work can still be done in your home country or other countries if that's the need, and you can get the R&D tax relief. It does also extend to subcontractors. So if you're subcontracting some of this work, that also counts, although that's restricted to 65% of the costs as a baseline. So if you spend £100 on a if you say, right, we want some research done on this particular area, you invest, you say a group of developers in, I don't know, Czech Republic, you say, right, we've got that project on the go, you'd be able to claim, you get 65% of that cost would qualify towards the R&D claim. So very generous. It tends to be quite, they're quite good. They tend to reply we within about a sort of 30 days, I think they have to apply within 30 days of the initial claim, and then you occasionally get the odd questions backwards and forwards, but typically, once they've approved it, the cash comes through fairly quickly. It's been a lifesaver for a lot of the businesses during the current pandemic. So definitely one to think about. I think obviously there a lot of companies have home country similar schemes, and that doesn't necessarily preclude you from shifting to the UK and making a claim. You just can't double dip. So if you've obviously claimed on some expenditure in your home country, you couldn't then use that same cost in the UK, but you could shift the R&D management to the UK, and maybe this scheme might be more generous than your home country.
Yeah, I think the key takeaway is explore this. Some of the clients I work with in their home country, it's so difficult. The expert in that country is an expert in the field that just makes it so difficult to claim the R&D. And when you raise it with them in a meeting, they go, "No, I've had enough of this. It was hard enough where I dealt with it." The expert here is the tax man. All right, they'll have a certain skill level to understand, but they're not experts in the field. And because of the definition of what you can claim R&D for, it's so much more flexible. And we've had businesses that have sort of flipped the company to the UK because they're focusing on development and putting their IP in the UK, which I'll talk about in a minute. And yeah, they couldn't believe how much they could get out of this. It was really helped them, as Ian mentioned, particularly during COVID-19.
I'll move the slide on. So I know, again, you've had various investment things, so it's really just covering. I mean, one of the key things we get asked numerous times, and one of the sort of key things we get questions on is EIS scheme. People are looking for funding, and it is very generous. You have to be a qualifying company, qualifying trade, and there are massive numbers of rules. I'm sure you've already. I don't know how much detail people have been into, so I can just go a quick overview on this. Is that
I think this is a very useful slide. I mean, we've touched upon it, but not to this level.
Okay,
fine. And I think the key thing is to point out, how it benefits UK taxpayers. Yeah,
exactly. So great. So I didn't want to sort of repeat something that people have already listened to. So so the key thing, the reason why EIS is so valuable is a UK investor, individual investor. So this is typically an angel investor. Gets 30% of their investment in an EIS qualifying company back as a deduction against their tax bill, up to £1 million a year. So they can invest £1 million and they'd get a 300,000 credit against their other taxes. So that alone is extremely valuable to them. If they hold that investment for 3 years and the company continues to qualify for EIS for that period, any subsequent sale of those shares is also free from capital gains tax relief. So from capital gains tax, there's a full 100% relief on EIS shares after 3 years. So effectively, not only do you get 30% deduction going in, but you pay no tax on the upside. So you can imagine most angel investors quite like this. And typically, if you're looking for fund, one of the first questions people often ask when fundraising is this going to qualify for EIS? And if it's a business, it's a trading business, there are various companies that are precluded. So, some financial services businesses are precluded, professional services are precluded. But basically, sort of fintech as such, depending on what you're doing, may qualify. We've got EIS company. We've got a company that provides software to banking system. They've got all the big major banks as customers. And that's been a qualifying company for EIS for many years. So it's just there's a definition. The company needs to be active. It can't have assets. The other issue is the company can't have assets of more than 15 million gross assets, so total assets. So if you add up your balance sheet and say, well, what my total assets on the balance sheet, as long as it's less than 15 million, you can potentially qualify. The biggest risk on it, actually, and the reason people get very twitchy is that the company, if the company fails to meet those criteria at any time during that 3 year period, the EIS investment effectively fails, and that leads to very, very unhappy investors. So it's something you definitely need to sort of monitor if you go through this process and get the qualification and attract UK investment. You need to monitor this, and particularly in subsequent share rounds. There's a lot of bear traps where, we've had one where, all qualified and then they issued shares to the same investors at a different class with preferential rights and another round without thinking about it, and it caused the whole EIS scheme to fail, which didn't please certain people. So it's one of those you do need to be monitoring it. I mean, we're sort of almost pathological about it. Clients that have got EIS schemes is making sure every time they're doing an investment round, every time they're doing something, make sure you're still qualifying and still, because it's a fantastically attractive investment. It de-risks things massively.
One thing that you haven't covered is that, of course, if the company, and we hate talking about failure, but some businesses do fail, then of course there is an additional tax parachute for the investor.
Correct. Yeah. So obviously, if it's shares in an EIS qualifying company, there is a tax. If the company does fail, then they can offset that loss against potentially, against income, etc. So there is another, it's many ways that it's of benefit. So I'm just conscious of time, so I'm going to move on. SEIS, I'm just flagged it because it effectively follows the same sort of principles as EIS, but it's for very small companies. So only companies that have got total assets at the date of investment of £200,000 or less. But the investment criteria is even more valuable because it's 50% deduction against your income tax bill for SEIS. I'll just mention venture capital trusts because they are effectively quite often, when in particularly larger business, more established businesses, it's a sort of financial product of pooled EIS qualifying companies. So there are a lot of products out there where, the venture capital trust will be looking for qualifying companies. They may have, there might be typically a fund with 30 EIS qualifying companies. It de-risks it for the investor. But obviously each of those companies underlying that needs to be EIS qualifying, but it's just it's just a point I wanted to flag. Ross?
So protecting IP and what processes may change post-Brexit. In terms of your IP, I think the key takeaway, irrespective of Brexit, it's the UK is a safe place to keep IP. You should look to put the IP and the trademarks in the holding company, the one that's not trading as such, or you can obviously keep the IP individually if you're an entrepreneur. The reason for that, it just enables an adequate level of protection. You're well protected if things go wrong operationally. And the reason why it's still good in the UK, we've got a strong legal framework here. We've got good systems of protecting people's IP, trademarks, patents. It's a safe haven for IP protection, and also with R&D grants, it's a good place to put your IP. In terms of trademarks, what's going to change? Well, if you have EU trademarks and UK trademarks. If you've got an EU trademark and you've got it before the end of the transition period, which is the 31st of December this year, the UK will automatically give you a UK mark. So you'll have a separate EU and UK mark, so that you've got your trademarks in the UK and the EU. What I would say is obviously register your trademarks everywhere you trade to protect yourself properly. You don't want anything being stolen. Once you've got a separate EU and UK trademark, there'll be separate renewal fees and costs. From the 1st of January next year, if you want to register in the UK and Europe, you need to register in the UK using a UK-based representative, and in Europe, you have to use an EU-based representative. One key issue that comes up is that you need to register business names. Just having a limited company with the name does not protect the name. You must register the name as a trademark, and in the UK you can't reserve business names. You've got to register. That's the key takeaway. You can also have a registered company name and a separate trading name, but if you are going to use a separate trading name, just check that you're not going to infringe any other businesses' trademarks, which I've what we ran through with a client recently, which was with a big brand, had the same name as what they use in New Zealand, so they had to have a rethink on what they were going to trade as. Registering trademarks in the UK and in Europe is fairly straightforward. Once the IP office in the UK and Europe has checked and accepted that it's something that meets the requirements of a trademark, there's then a 3-month opposition period. If you get through the 3-month opposition period, you can have the trademark registered. On a final point, I'm just cautious of time. Registering patents, yes, it's a great way of protecting your IP. If it's a scientific base or algorithmic properties, but you've got to publish a significant amount of detail, so you're probably giving a lot away. But if that's a requirement, what we would recommend is that you go to a specialist patent attorney to make sure you do the required registrations and go the right way about that. But obviously, registering a patent, you're giving away a lot of intel because you've got to publish a lot of information to get it registered. I think we can finish off with questions, Pete, Ian, or we can just cover a few business hacks.
I've got a couple of, I was just going to raise 2 things. I think obviously the budgets one you've got here, which was obviously just, it does sound really stupid, but you'll be amazed as well, just how many times this doesn't get put up. People haven't sort of got the proper business plan laid out, thoughts, this is what it's going to cost, how do we get through? I'm conscious of questions, so I'm just going to raise, one other thing which isn't on the slides, which I've sort of flagged. If you are looking at premises here, just bear in mind that obviously quite a lot of people now using shared space. There's WeWorks and all these wonderful people. But one of the things that I think you need to think about is, there's going to be a lot of commercial property available on the market at the moment, and people are going to be desperate to try and get tenants in. So one of the biggest ones to look at is if you're being offered a nice little tail end of a lease. So it might be a 25-year lease that's been in place, and they say, all right, there's only 18 months left on this lease. You can have it for, £2,000 a month, central London office. People sort of think, oh, great, that's really good. But just be very cautious on that, and make sure you take legal advice on the lease, because we have this thing in the UK called dilapidations, and whoever is left with the sort of tail, in situ at the tail end of the lease, may have the obligation to put the entire premises back to the condition it was in at the start of that 25-year lease. So this actually happened to a US business we deal with, where they didn't look at it. They didn't want, they knew best. They were sort of crowing about, oh, we've got this fantastic office on, I think it was on Oxford Street in London, and it's great and blah blah blah. And then it came with a £750,000 dilapidations bill, which they were then potentially going up to £5 million of dilapidation costs. So it's one of those, just bear in mind, don't just look at what you're buying and just be very conscious of that, because that's one that a trap that people do fall into quite regularly.
Yeah, and probably just reinforcing a few points we've made earlier on talent. Get the local talent hired. Get the right talent. They know the market. The best advice I've received from clients on their story when they've done it a few times and been around the world a few times is, what we should have done is, if we're going to transfer our staff to the UK, send your second or third best salesperson. Don't send your best one, because it's going to affect your home country. That's and the parent company that could be funding the UK for a while. The second or third best salesperson, they won't be missed as much, and with a new ambitious local hire, they can really make the UK a hotbed for customers. Think about the time zones. You're going to be in different time zones. You don't just keep doing what you always done in terms of team meetings. You've got to embed people, get the new hires in bed, make them feel part of the business. That really touches on the employer brand. Just make sure you can connect with them all, and the meeting isn't just about why the sales so poor. Just try and build them into the employer brand and what you're all about. Finally, unless
I would leave that, Ross. I think we've got to get to the questions.
I mean, there's things we haven't had time to cover, GDPR, and obviously we can talk about Brexit.
There's a session next week on GDPR.
You lucky people.
It's going to be a wonderful session. But no, it's
cool.
But that's a great presentation, Ross and Ian, and as always, lots of useful tips. And once again, this is about sage advice, but also avoiding mistakes. And for every nightmare story that they've told, I can think of another 10.
Yes.
Oh yeah, definitely.
Yeah. So our job is to make sure you don't have a nightmare. So moving on to some questions.
Yep.
I see Terence, and I don't fully understand the question. Hopefully Ian or Ross does. Is there no DWT for individuals too?
I'm guessing I think that came up. I saw that when I was talking about withholding tax on dividends. So I'm guessing that's dividend withholding tax.
Yeah.
So no withholding tax on dividends for anyone. So the UK, that is a very simple point. So the UK, if you're paying a dividend out of the UK to anyone, anywhere, anything, there's no withholding tax at all. There is personal withholding tax on interest payments. From a company to an individual to an overseas company, potentially subject to tax treaty, and on royalties and things, but not for dividends. So no withholding tax on dividends to individuals.
Fair.
Hopefully that was the answer.
Yeah, Bruce has come on camera, so Bruce, fire away. He's on mute. He's about to try and come off mute. Here we go. Bruce, over to you.
All right. Thank you for that, Ian. I had to find the mute button. Question on SEIS. When you talk about assets, does that mean the Aussie assets, in our case, going to the UK, of the parent company, or is that of the capital we're putting actually into the UK? This is for SEIS purposes.
Ian, you're on mute.
Yeah, sound's gone.
No, it's the first time Ian's ever lost his voice, isn't it, right?
Yes. Maybe just try and plug in the headset, Ian. Yeah, still not.
Well, we can take the question on notice. That's fine.
I'll take it. Yeah, I've got it. I'll do it.
Oh, there we go.
You got it?
You're back.
I don't know what happened there. Anyway, so sorry. Yeah. So because the investment has to be in the parent company, or you've got a branch of it's the parent company effectively. So it's very limited. It really is for really early stage businesses. So yeah, it has to be. If you've got more than £200,000 of assets in the company that the investment's going into, that's it. You're outside the criteria.
Cool. Thank you.
Okay.
Then a question from Simone Joyce. Can you register a name before you have a business registered in the UK? So I suppose it's about getting the IP protected.
In short, yes. you just need to check. I mean, part of it is checking whether anyone else may challenge you. Any established businesses. There's a whole register. So for in the area that you're working in the trademark type, you just need to check whether there's going to be anyone who may oppose this, and that's something that our team would look through and review with you.
Excellent. And anyone else with questions? Just put your camera on if you want to sort of speak to Ian and Ross directly, as opposed to writing down there. Hang on, Terence has come up. What's the approximate cost? Oh, right. How much do you charge, Ross and Ian?
Oh, well.
very reasonable, I believe.
Very reasonable. I mean, I think obviously what we have is what I can do if Pete's happy is we've got a sort of summary of fees, and just as a sort of as an overview, we like to sort of obviously bespoke it, but we can upload that if you like, Pete, just so that that's available if people want that as a schedule. Because I don't want to waste everyone's time talking through everything, but it gives a good indication.
Of course.
Overview.
Of course.
We'll upload. We'll upload.
what I can say is that compared with the big four consulting firms, I won't name them, you know who they are. They're much more reasonable, and these are practical people as well. So that's the key thing. I see Robin's come on camera. I will come back to Venkatesh's question as well. So Robin, over to you.
Yeah, hi, Robin Sands from Link4. Ross, a question for you on the ancestry visa. How far back does that go? Apart from the fact I've got some that came over in 1850 on the ship, but how many generations does that cover?
Yeah, so it has to be your grandparents. They've got to have been born in the UK and British. If you go I normally find there's a few that go one step beyond that and you just miss out. Yes, unfortunately.
Cool, thanks.
And the question from Venkatesh, minimum cost, annual cost of maintaining a company bank account with a UK bank?
I think the answer to that very much depends. Some of the banks charge for the account. So I think I give an example. Metro, it's £1,000 setup, and then they normally have a charge of £100 a month as the minimum charge. Other banks, they don't necessarily charge the traditional ones. It does vary bank to bank. It's something that they would have to give you that information.
I mean, quite typically, if it's a relatively small account, so it's, I mean, when I say small account, in their retail banking division, maybe up to sort of turnovers of about $1 million, you may get, free banking for 6 months or something as an incentive. But, what they tend to charge by transaction, so it tends to be transaction-based charges. So you might, every credit to the account, you'll get charged something. Every debit to the account, you get charged something. So it does really vary bank to bank. But typically you will be paying for something. But obviously, if there's large volumes of transactions, that tends to be much more expensive than if it's relatively, if you're a sort of consulting business and you're getting big lumps of cash deposits and then just sort of relatively modest monthly thing. It wouldn't be that that expensive, but large volumes definitely is where it starts getting a bit more racy.
It's also worth mentioning that banks will make money out of your money, and particularly the larger banks, they tend to charge a lot around foreign exchange. So I would suggest that you may have a Barclays account, and that's fine for sort of day-to-day stuff. But FX, I wouldn't use them because they will take a large slice of the transaction. There's plenty of other good options out there, TransferWise, Air Wallets, and others, that actually provide a pretty good, sophisticated service that is a much smaller fee. And I think it's also worth mentioning that there's a lot of innovation coming through, new ways of transferring money and paying bills, etc. So yeah, we'll try and put together, I suppose, a glossary of best practice, best options, because I think there is a lot of evolution happening at the moment. But don't put everything through one big bank because you'll find you'll pay for it.
Yeah. I think Bruce is confessing to be a Scot, so I don't know if looking at that.
Go, Bruce.
My mother was a Scot.
Yeah.
So.
Yes. My mother is from just south of Glasgow, so she was a dear lady, but also my lovely wife and co-founder is a Brit, so she's English. It shouldn't be too hard, surely, for me to get a passport.
Yeah, that sounds like you're onto a winner there, Bruce. You should be able through your mother.
Me that all the time.
Through your mother, you should be able to explore getting a British passport. That shouldn't be an issue. Scotland still wants to be part of England and the like at the moment. So that's an option. The other option is the spousal visa because of your wife, and there's just a financial requirement to that. So my first protocol would make sure that you can get that UK passport, and I'd explore that. And then if that fails for some reason, there'd only be a technicality for that. You would look at the spousal visa then.
Oh, thanks for that. Look, I'll obviously do that, and I'll keep my options open for when when Scotland secedes and goes and joins the EU, and I'll get my EU one that way.
Exactly. Keep your options open. The number of people who suddenly became Irish during Brexit who got their Irish passports, because the pet dog was Irish, but just to stay part of the EU.
Don't get me wrong, I was actually looking to see if I had any grandparents that were, but I have to go back too many generations.
Right, we've got I suppose another 5 or so minutes. So if there's anyone else that wishes to come on screen and ask away, this is obviously free advice. I mean, normally sort of Ross would charge by the hour, and no,
very reasonably though. Very reasonably though.
That's right. Okay, well, I think we're done here. Of course, if there's anything that comes to mind, just come back to either myself or my team, and we'll relay those questions on to Ross and Ian. And of course, if you feel that Uri Clark may be a firm to support your journey, we wholeheartedly recommend them, and just let us know, and we'll make sure that you're properly introduced and given the best possible service. And of course, we'll ensure that they take you out for a drink in the fine establishment near their offices.
We're very good at that. We're very good at that.
Excellent. All right.
Thanks, Pete.
No, real pleasure. Actually, hang on, Venkatesh has come back. My grandparents and dad were born in British India. Does that help to qualify?
Possibly not, is the answer. I think that's one that you'd need to explore, because it's about the birthplace being the UK. There might be something very unique on that, but my gut feel is that I don't think that will work.
Yeah, there's obviously a number of free trade agreements being negotiated, and that includes transfer of talent and visas and qualification. I'm not quite sure where the Indian FTA is at the moment, but there's going to be some cross trading on those kind of situations.
Yeah. There's opportunity. I think there's going to be a lot of opportunities coming up.
Yeah, absolutely. The rules will change, and hopefully for the better. Good. Yep. Okay. Well, thank you very much for attending this session. And of course, in 15 minutes, we'll be back on air with Zoe Spicer. And as I say, reason why I think this is such an important session, yes, it's about the UK and it's about talent and so forth. This is actually about your business, and this is about your culture. And Zoe is, world class in helping companies think through the important things of getting, obviously the right staff attracted, but also making sure you've got a culture that can scale globally. And this is the thing that you have to think about. What you are in New Zealand, Australia, India, is great, but you have to think of yourself as a global business. And this is where Zoe can add a huge amount of insight and experience on how do you evolve from a one country sort of business to a multi-country business. And yes, it's early thinking, but you've got to start planting those seeds and ideas now, because it's critical that you have a global business culture, not just a local business culture. And so that's one of the key aspects. And of course, there's many other ideas and experiences she can share. I'll be on the call as well, giving my 2 cents worth. But please go away, make a coffee, cup of tea, whatever you want to do, or a glass of wine, and we'll see you back at 9:30 BST. Thank you very much.